All right, in today's episode of Term Sheet Teardowns, we're going to talk about preferred returns. Now, preferred returns, you used to not see them very often, frankly, because term sheets were generally like super entrepreneur friendly, but you're starting to see them make a comeback. And that is because, there's this difference in the bid-ask spread, as we call it. Entrepreneurs are asking for one valuation and VCs are bidding on another. And so in order to get them together in terms of the valuation that they're both willing to agree to, the VCs are becoming creative in the types of structure that they'll add to the deal to ensure that they get the return that they want, while the entrepreneur is able to get the return or the valuation and associated dilution that they're looking for. And this can be important because if you're an entrepreneur and you raised at a high valuation, you don't really want to take a down round. Because when you take a down round, it really hurts morale. It drops, puts people underwater on their options. It signals to the market that, something's wrong with your company, etc. And so being able to maintain your valuation or maybe even have a slight step up, even if it comes with some structure, might be important and worth doing as an entrepreneur. So VCs have a number of different tools and levers that they'll use, and preferred returns is one way in which they do it. So how does a preferred return work? What is it? Let me preface this by saying this is not legal advice. Please go see an attorney to get more detailed legal advice, but hopefully this is helpful from an educational and entertainment perspective. All right, so a preferred return is, simply put, what it sounds like. It's a return that's preferred to the investors before anybody else gets paid back. The way I've seen this done is you'll have the investors will put in terms such that their preferred equity acts kind of like debt. And so it will have an interest rate, more or less, associated with it that's called a preferred return. And they'll say, okay, we need to generate at least a 20% preferred return on our investment compounded annually. If that doesn't happen, then we won't convert to common, but if it does, and the company gets acquired for a number that generates more than a 20% preferred return for us, then we'll convert to common and that'll be fine. Otherwise, we are going to get paid out that amount before anybody else. So let's run through a math example just to make it a little more concrete. Let's say that I, as the investor, put in $1 million into the company, and I have a 20% preferred return hurdle that the company needs to hit. Well, if I put in $1 million and end up buying 10% of the company, and then the company later on gets acquired for $15 million, let's just say, right? And they do that within a year, well, that's a 50% gain. That's more than the 20% gain that I would have gotten under my preferred return. And so in that case, what would happen is I would convert from preferred shares into common shares and I get my 50% bump. But what happens if instead of getting a $15 million exit in 1 year, I end up getting a $15 million exit in 5 years? Well, in 5 years, under a preferred return structure where it's compounding annually, that amount would be a lot higher, right? I put in my $1 million. I'm not looking for just a 20% return. I'm looking for a 20% return every year compounded. So in year 1, it would be an additional $200K, so a 20% increase. So in that example, I would need to go in year 1, I would go from $1 million investment to 1.2 million. In year 2, though, it compounds. So I take that 1.2 and I multiply that by a 20% return. That's going to return an additional 0.24, 240,000. So that gets lobbed on the top. Then the next year, it's going to be a 20% gain on top of that. So now we're looking at almost 300K of additional. And then that goes on top of that. So that's a return of 1.7. And then that gets multiplied by a 20% gain. So now we're talking 2.3 million. And then eventually after year 5, we're talking about $2.7, $2.8 million that your $1 million investment will have grown by. And so if the company doesn't sell for an amount that gets you at least a 2.8, 2.9 return, you're probably going to remain as preferred shares and just take that off the top. So in that case, the company gets acquired for $15 million. With your preferred return, you would take the first $2.9 million. So let's just round it up to $3 million, leaving $12 million for common shareholders and the rest of the investors to share if you have a preferred return. Versus a standard liquidation preference where you would just get like a one-time liquidation preference, you just get your $1 million back. This is a way to guarantee as much as possible that you still generate a good return even if the company has a less than ideal outcome at exit time. Like I said though, preferred returns aren't super common, and even as a VC, like a 20% compounded return equates to a 20% IRR, which is great, don't get me wrong, like that's better than what you can get in the public markets generally speaking. But as a VC, like I'm really shooting for like 30, 40, 50% IRRs on my investments. And so it can also be a little bit of a middle ground where the VC is saying, hey, look, I'm not getting the 30, 40, 50% that I really want to get if with this preferred return, if things don't work out the way we all hope they do. And so, you know, yeah, but it is going to be hurtful to you as the entrepreneur because I'm going to at least get this 20% return. Now you could have cases, and this where like maybe you don't sell for 15 million. What happens if you sell for 4 million? Well, if you sell for 4 million, the VC is still going to take out that $3 million from the preferred return, leaving common shareholders with just $1 million to split up. And it could get even more egregious where like the company basically sells for its, you know, its assets, the computers that it's got, whatever, and maybe it sells for $1 million, in which case all $1 million will go back to pay the investors given their preferred return and their liquidation preference. By the way, preferred returns aren't just for VCs and entrepreneurs. Oftentimes you'll see preferred returns show up with private equity funds. That's very common. And the other place it shows up is actually between private equity funds, private credit funds, and sometimes venture capital funds and their investors. So oftentimes, especially if you're a new venture fund or you're a debt fund or a private equity fund, your investors will require a preferred return from you before you get to split any of the profits with them. So the way that works is usually they're not like 20%, usually they're like somewhere between 5 and 10%. So in that case, what happens is the LPs are paid out all of their money that they invested first, and then they're paid 5% or 10%, whatever the preferred return is, compounded annually until they're paid back that full amount. And then what happens is the general partner gets to play catch up. So they then get all the next dollars that come out until they're caught up to their 20% of the profits. And then every dollar above the preferred return is paid out 80-20 between the LPs that get the 80% and the general partners of the venture or private equity fund who get the 20% as their carry. This is a mechanism that's used to basically provide some downside protection and lock in as much guarantee around return as possible. And for the LPs and the venture investors or the private equity investors or the debt fund investors, it's a way to basically say, you're claiming that you can do a better job than the market. Great. I believe you, but I want to have a preferred return just in case you're being a little ambitious and can't actually beat the market. At least that way I know that I have a higher likelihood of getting a return that I would have gotten had I just left my money in the public markets. Anyways, hopefully this is a helpful video around preferred returns, what they are, how they work, and why they exist, and why they're kind of making a bit of a comeback right now. If you've enjoyed this video, be sure to check out all my other term sheet teardowns on the playlist that you can find on my channel. Thanks.